Neil Dutter's language. The bond market is either pricing in too many rate cuts or not enough. Priya, which one is it?
I think the market is actually pricing in both, right? The market has to price in weighted average probability of outcomes. I do struggle with the average pricing here because the market's saying the first 25 basis point rate cut happens in September, but then the Fed only cuts 175 basis points. I think if we're looking at a hard landing, we're in the hard landing camp. The Fed's going to cut much more than that 200 basis point that's priced in. But our view is that the Fed starts those cuts much later. So they start later this year and then they cut a lot more. But I think the market's pricing in, I would call it a sort of bimodal distribution. There's a view that this blows over and there's no lasting impact of the bank crisis. And so the Fed gets rates to 5% and then very slowly, according to the dot plot, cuts rates to 3%, over the next couple of years. And then there's this view that there's going to be a hard landing. There's much more to come here. And therefore, the Fed will have to cut more. I think we don't know. There's high uncertainty. That's why the bond market's moving 25, 30 basis points every day. The market's pricing in this weighted average probability, and those probabilities change, every day or multiple times a day. So we are pricing in sort of both these outcomes.